once again, it's your boy, it's your friend, it's the credit doctor, Angelo McCutcheon, coming to you with another quick video on the credit repair process. And I want to welcome all of my Facebook Live people and my YouTube Live people as we're starting a new series called the Credit Repair Show. I won't say a series, but this is now our credit repair show. And we're going to come to you hopefully every week, at least every week, once a week, and bring you information on the credit repair process. And of course, if you want to come into the chat room, if you're on YouTube, you can just make your comments and we'll see that. If you're on Facebook, well, if you're in my group page, you may not be able to come into the live chat, but you can always type in your questions and we'll check it out after that. But of course, we're bringing to you all the information that you would need on these broadcasts to understand that you do not have to live with bad credit. Now, as the credit doctor, someone who has been in the business for over 10 years, helping people repair their credit, haven't had my credit bad at one time in the low 400s, now in the 700s, able to understand what the law says, the Fair Credit Reporting Act and the Fair Debt Collection Practices Act. Those are the two laws that help you understand what creditors can and what they can't do when it comes to putting information on your credit report. And if they violate those laws, then you have options. You could dispute information that is negative on your credit report. And of course, if they can't fix it or verify the information, they must delete it. Or if they continue to violate the information, you can go to a consumer attorney and file a lawsuit against them. All right, so there's things that you can do when it comes to cleaning up your credit. We're going to provide the information that you need. Now, remember, I also have a podcast that can be heard. It's called the Credit Repair Show. It could be heard on every platform, Spotify, iTunes, Google, all that stuff. Just look for the Credit Repair Show with your host, Angelo McCutcheon. We've got about 40 podcast episodes that's up and running already, so you can get to that. We touched on every subject, on judgments, bankruptcies, charge-off collections, how to talk to a debt collector, all that good stuff we got up there. So if you listen to podcast shows, please check out my podcast called The Credit Repair Show with your host, Angelo McCutcheon. All right, so now we're coming to you to build up our YouTube page now to give our YouTube audience more information when it comes to cleaning up their credit. All right, so what we're going to talk about today, we're going to do a quick presentation, and we want people, because a lot of people ask the question, to fight my scores. What's the deal with the scores, right? Every time I check somewhere, if I check Credit Karma, it gives me one score. If I check my bank, it gives me one score. The FICO score gives me another score. I mean, the scores are never the same, right? And we're definitely going to do a video presentation on that. But what we're going to touch on today is understanding the main score, which is your FICO score, the Fair Isaac Credit Company. Right, we're going to deal with that. We're going to show you how they started, how they began. They're the big boys. 90% of lenders still go to your FICO score. They don't go to your Vantage score. All these other scores that is out there, Credit Sense, Credit Score, all those stuff. The main ones, 90% of your lenders are still looking at your FICO score. All right, so you need to know something about the FICO score. All right, and we're going to try to give you some information concerning that. So let's start, and we're going to give you a backdrop on the history of FICO, and we're going to work our way up. So let's start our presentation. Let's get right into it here. All right, so the first slide says how your FICO score really works. Discover how you can easily control all 5 secret ingredients of your FICO score. All right. Now, who is FICO? FICO is a business analytics software company. They are based in San Jose, California. FICO was founded by Bill Fair and Earl Isaac in 1956. Their FICO score has become the main credit score used to determine consumer credit risk. As I said earlier, 90% of creditors, when they want to determine what your score is, they go to your FICO score. All right, so that's important to know. FICO was founded in 1956 as Fair Isaac and Company. That's what FICO actually stands for, Fair Isaac and Company. William Fair was one of the original founders and was an engineer by trade. Earl Isaac was another founder and was a mathematician by trade. The two men uh, the two met while working at the Stanford Research Institute in Menlo Park, California. In 1958, FICO pitched their first credit risk analysis system to 50 Americans. Let's see here. FICO went public in 1986 and is now traded on the New York Stock Exchange under the ticket symbol FICO. Now, I just want to show you how big they are and why it's important that you understand and know what your credit scores are and who they come from and where lenders are going to look at least 90% are going to look for your credit score. The company debuted its first general purpose FICO score in 1989. So I want you to know they've been around a long time. Scores are based on credit reports and range from 300 to 850. Lenders use the scores to gauge a potential borrower's credit worthiness. Fannie Mae, Freddie Mac first began using FICO scores to help determine which American consumers qualify for mortgages bought and sold. Let's do here, so I don't want to cover this up here. Let's see what we can do. Okay. Mortgage bought and sold by the company in 1995. Originally called Fair Isaac and Company, this name was changed to Fair Isaac Corporation in 2003. The company rebranded again in 2009 is now called FICO. That's what we know it by, making their name the same as the signature FICO score they offer. Originally was based in San Rafael, California. They moved to Minneapolis, Minnesota in 2004. Then they moved back to San Jose, California in 2013. To grow as big as they are today, FICO has acquired many smaller companies along the way, which included Denmark. This is a list of companies that they just took over. All right. So again, they was like one of many when they first started out. Companies that was trying to come up with a way of giving lenders a credit worthiness look at how, whether or not they should give you credit. Right? But they basically brought out all these companies, so that's why they became the powerhouse. All right. Customer acquisition analysts, debt management and collection analysis, fraud and security analysis, risk analysis scoring, and I should say debt management collection analytics, risk analysis scoring, customer decision making, and analytic data solution. Those are the services that FICO offer. All right. And then let's look at the FICO score. The most widely used credit score is the FICO score. And I want you guys to really understand that, right? The FICO score is the FICO score is mathematical model that is used to depict a consumer's risk of going 90 days late on an account within the next 24 months. Lenders use the FICO score to help them make billions of credit decisions every year. How important is your credit score? Lenders use it to make billions of credit decisions every year. Now, if you don't know what your FICO score is, you need to know what it is because it could be hurting you or it could be helping you. You don't know. I have a lot of clients who, when they come to me, it's like, I don't even want to look at my credit score. I know it's bad. And in a lot of cases, it is bad. But in some cases, not as bad as they thought. But just because they wouldn't look at it, they didn't know the potential power they had from having good credit. So it's important to know what your credit score is. FICO calculates the FICO score based solely on information in consumers' credit reports maintained at the credit reporting agencies. So the way they calculate it, and they have their own formula, but it's based on all of the information that's in your credit report. Remember, we'll probably get to this later, 35% of your credit score is based on your on-time payments. 30% is based on credit utilization, how to use your credit cards, right? Another 15% is length of credit, then you have a mixture of credit, and then you have new credit, which both those are 10% of your credit score. All right. And again, the score ranges from 300 to 850. The FICO score is calculated by a I can't say that word. Equation that elevates many types of information from your credit report at that credit reporting agency. By comparing this information to the patterns in hundreds of thousands of past credit reports, the FICO score estimates your level of future credit risk. Basically, what they're saying is, based on all the information in your credit report that gets updated every 30 days, right? They come up with a system that says, hey, this consumer has a good score and is worthy of credit. This consumer has bad credit, is not worthy of you taking a chance giving them credit. And that's basically what they do. They come up with a formula based on information in your credit report, which tells me you should know what's going on in your credit report. If you don't know what's being reported, that's not good, because lender's going to look at it and see it, so you need to see it. All right. You have 3 FICO credit scores, one for each of 3 credit bureaus. You have your Equifax, your TransUnion, and Experian. Each FICO score is based on information the credit bureau keeps on file about you. How you pay your bills, any law, charge off, late payment, judgment, things like that. The FICO score from each credit reporting agency is considered only the data in your credit report at that agency. And I shouldn't say judgment because they don't report judgments anymore. All right. So you have 3 scores, one from Equifax, one from TransUnion, and Experian. Right. Now, obviously, when they average it out, they usually throw out the highest score, the lowest score, and that middle score is the score they will use to determine whether they're going to extend you the credit or not. All right. And again, it's based on information that's being reported to the credit bureaus that they have on file about you. Your score may be different at each of the main credit reporting agencies, and that's true. Everybody who looked at their credit know that 99.9% of the time it's never the same score. If your current score from the credit reporting agencies are different, it is probably because the information those agencies have on you differs, and that's exactly correct. If your information is identical at all 3 credit reporting agencies, each FICO score should be very close, all right? For your FICO score to be calculated, your credit report with the bureau from which you want your score must contain enough information and enough recent information on which to base your credit score. So if you're the type of person who never got credit because you paid all your bills on time, you used cash, not on time, but you used cash for everything, and so now you want to get a house that you can't pay cash for, and you want to get some type of credit, well then if you really never had credit before, you're going to have something which is known as a thin file, and that's not enough information for the credit bureaus or a lender to make an informed decision on whether to give you credit. So while credit is important, you got to make sure you have that established. All right. Generally, let's keep reading. That means you must have at least one account that has been open for 6 months or longer, and at least one account that has been reported to the credit reporting agencies within the last 6 months. Again, when you're establishing credit, you may have to get a secure credit card, or you can get something called a self account, right? Because you may not, when you're starting out and you have no credit, you may not be able to get a big credit card or anything like that. So you may have to start out small, right? But you can build it up. Over time, you can build it up, all right? So let's look at different types of scores. There are many different credit scores out there, as I said earlier. There are credit score consumers can pull themselves through credit monitoring, right? Like Credit Karma, Credit Sense, Identity IQ, things like that. Or through a mortgage scores, auto scores, and many more. So people don't realize that when they're looking at their credit report, that they also have a mortgage score, a auto score, a credit card score, right? And even though they only see one score, you got to factor into the fact that if you're looking for a mortgage, you have a mortgage score. You're looking for auto is going based on what they feel your auto score is, all right? So that's important to know. And there's a whole lot of other ones out there too, banking score, things like that. All right, next thing says there are actually over 16 different credit scorecards that exist today with FICO alone, and that's true. Each of these scores will reflect different credit scores. These scorecards are designed to help particularly, let's move this again. I'm sorry there. That's okay. These scorecards are designed to help each particular industry better gauge credit risks. Right? The mortgage industry, for example, is more concerned with a consumer's past mortgage history than anything else. So they weigh so they weight home loan history heavier into the total score calculation than other accounts. So a consumer's credit monitoring score might be 660, but when they apply for a mortgage, their score might be much lower due to some past negative mortgage accounts on their report. Their mortgage score might even be higher than their consumer score if they have past positive mortgage accounts. So that's important. All right. So that's more of the same information. The Vantage score, that's another score. And Vantage score is usually offered by Credit Karma. Some other monitoring services might offer the Vantage score. And again, 90% of consumers are going to look at your FICO score, F.I.C.O, Fair Isaac Corporation. All right. Plus, different scores are offered by different companies, creating even more credit scores. FICO is the biggest provider of consumer credit scores, but now even the credit bureaus themselves are in the credit scoring game, providing their Vantage score. And that's where the Vantage score came about, because the credit bureaus came up and said, hey, FICO score, the FICO company is doing big with these credit scores. Let's come up with our own method of coming up with your credit scores. And even though it isn't as strenuous as the FICO score, the Vantage score is just something that most lenders are not still comfortable going with when it comes to, again, some of them do. About 10% of them still will look at your Vantage score, but it's not something that overall is comfortable with going with because of the history of FICO score being around for so long. The Vantage score was unveiled by the three credit bureaus in March of 2006. All three main credit reporting agencies use the same formula to calculate the Vantage score. Vantage scores has scores as high as 990, while your FICO score only goes to 850. So even though a 700 FICO score reflects good consumer credit, a 700 Vantage score reflects below average personal credit, right? So they're standard. You go from bad to, fair, good to excellent, something like that. Here are the Vantage scores 2.0 risk levels. A credit score for the Vantage score, not the FICO, 900 to 990. To get a B, you have to be 800 to 899. To get a C, 700 to 799. To get a D, 600 to 699. To get an F, 501 to 599. All right, that's the Vantage score. Obviously, scoring goes up to 990 versus FICO scores going to 850 have created an issue with lenders. This is one of the main reasons that Vantage score hasn't become widely accepted. So the bureaus have now changed their score range with a Vantage score 3.0, which was released in 2013. With the new Vantage score only go as high as 850. Now, so remember at one time they were at 990, but lenders was like, wait a minute, that's a little bit too much. So they dropped it down and said, your highest you can get is 850, the same as the FICO score. All right. So look at how some scores are calculated. All right. So let's. You have, again, we broke this down to you. Payment history. The Vantage score says it's 32% of your credit score. FICO says it's 35% of your FICO score. The utilization, 23% of your credit score for Vantage. And over here, amounts used, the same as utilization, 30% of your credit score. And then we have balances, 15%, depth of credit, 13%, recent credit, 10%, available credit, 7%. And that gives you your 100% right there. FICO, 35% history, length of credit, how long you've had credit, 15%, amounts owed, 30%, types of credit, 10, new credit, 10. That gives you your 100% right there. Fair Isaac and VantageScore hold their credit scoring formula as a closed secret, much like the formula for Coca-Cola or your grandma's legendary double chocolate chip cookie. Like, they don't want nobody to know. Basically, they give you the breakdown, but they don't want nobody to know how they actually come up with the numbers. They keep it a guarded secret. This can be very frustrating for consumers when they see remarks on the credit report like too many revolving debt accounts and not knowing exactly what that means. Fortunately, Fair Isaac and VantageScore have issued some public information about how they calculate their scores. So payment history against the top rated factor, we just went over that. Recency, this is the last time a payment was late. The more time that passes, the better. So if you've had a late payment and it's been 2 years or more since you had another late payment or since your last late payment, it doesn't affect you as if it was recent within 2 years. That's when you could lose like maybe like 100 points just for a late payment, up to 100 points for a late payment. Let's go. Let's move on here. Now, you can improve this aspect of your score by what? Paying your bills on time. So if you have a late payment and then you make the next 2 years of on-time payments, perfect, good. Also, the more accounts you have paid as agreed to offset the ones you don't still will also help your score. So if you do have late payments reporting on your credit, you can offset these by adding new positive accounts and making sure you have a lot of accounts you are paying as agreed to offset the accounts not paid as agreed. So in other words, just make your payments on time. We shorten that up. Just make your payments on time. How much is owed? Again, based on, that's usually credit utilization when it comes down to credit cards. How much of your credit cards are you using? How much, are you maxing them out? What's going on? The score looks at the total amount owed on all accounts as well as how much you owe on different types of accounts, whether it be your mortgage, auto, etc. Using a higher percentage of the credit limits will worry lenders and hurt the credit score. In other words, if you have a credit limit of $5,000 and you're using $4,000 of it, yeah, lender's gonna be like, I don't know, you're close to maxing out, and you might, just go into default with this credit card. So, what is the idea? Keep your credit utilization under 30%. I like to say under 20%, 10% even, but 30 is like the highest. Under 30% is the highest you want to go, right? But the lower, the better. People who max out their limits have a much greater risk of default, all right? Again, utilization. When it comes to revolving debt, credit cards, the formula looks at the difference between the high limit and balances. For example, let's say your customer has a MasterCard with a credit limit of $10,000 and they spend $2,000 of it. This is a 20% utilization. You're under that 30%, so that's good. The lower the ratio, the higher the credit score. So if you're looking for a quick credit score boost, pay down. And a lot of times when I'm talking to my clients and I'm dealing with my clients, I'm going over their credit reports and things like that, I often see that one of the major factors is they focus on the negative items on their credit, which is okay, but they tend never to look at the credit card utilization when it's hurting them. It consists of 30% of your credit score with FICO, so that's big. And I see that, they have limits of 1,000, 5,000, 10,000, things like that, but their balances, they're using too much of it, and that's hurting them. And they thinking it's really the negative items on there, but a lot of times it's that credit utilization. So be mindful of that. Okay, calculating the score, that just talks about that. Now let's talk about this. One more important habit. Closed accounts do not help and can hurt if there is a balance remaining. So if you close your account and you owe the credit card $100 or $50, just by closing the account, it's going to hurt. It's going to reduce your length of credit, which is going to hurt. But then it's going to show a balance when it was closed. It's going to hurt it even more. So if you're going to close the account, at least make sure it's paid off. You'll take the hit for it, but at least make sure it's paid off so you don't get a double hit. A long perpetrated myth has been to close accounts that are not in use, but this will hurt consumers in several ways, as we just talked about. As you know, overall an individual account utilization plays a major role in credit scoring. If consumers close old accounts, your overall utilization rate will increase, which will cause their score to what? Decrease. So if you have these accounts that you have for 5, 10 years or more, and you're not using them, and you end up closing those accounts, it's going to hurt you more than it's going to help you. So you got to think about that before you close accounts. Length of credit history, which is important. The longer you have credit, the better it is. All right. If a person is new to credit, then there is little that they can do to improve credit score. No newly added accounts can be backdated to improve this score aspect. You get added as an authorized user, which we're going to talk about in another video, to a family member's account that has been in long standing, and that can improve this aspect of your score. So becoming an authorized user can be a good thing. Again, calculating a credit score. Average age of accounts is another important reason to keep all accounts open. If a consumer has multiple accounts that they have for some time but don't use, they are still benefiting from the age. All right. And again, if you have accounts that you say, I really don't want this account, but I don't want to close it, then just use it maybe once every 6 months, twice every 6 months, right? Just use it for something to pay off cable bill or something like that. Go grocery shopping, but just use it because you want to benefit from the length or the time you've had that credit. Okay, that just talks about credit issuers. Again, new credit, recent credit. New credit is not always a bad thing. However, open new accounts can hurt a credit score, particularly if a consumer applies for lots of credit in a short time and doesn't have a long credit history. That can hurt you. So you got to be careful how you're applying for, going out there and applying for all these credit, these credit cards and these store cards and things like that. Be careful because it might hurt you more than help you. Okay, we got that. Okay. For most people, a credit inquiry really won't have an impact on your credit score. So people talk about the inquiries, right? Too many inquiries in a short period of time, like we just said, will hurt you. You could lose up to 10 points because of that. 15 in some areas. So you want to make sure that you don't have too many inquiries. And even though inquiries stay on your credit report for 2 years, then it falls off, right? But you don't want to have too many in a given year. Usually, lenders don't want to see more than 2 to 3 inquiries in a year, just in terms of you building credit and maintaining good credit. Anything after that, they start seeing 4 or 5 in 1 year or more, they're going to think that you're desperate to get credit and you can't get it. So that's not good. So types of credit, again, that's a mixture of credit, whether you have a mortgage or installment account, student loan, you have a car payment, or you have credit cards. So having a mixture of credit is good because they want to see how you're able to handle a mixture of credit. Can you make your mortgage payments on time? How you make your auto payments on time? Your credit cards are payments on time? Or any other kind of installment accounts. Credit cards are revolving accounts. Mortgages are like installment accounts. It's the same. You pay the same amount until the end of the loan. Likewise, a car payment, things like that. Right. Again, here's the breakdown. 35% of your credit score is based on payment history. 30% is based on utilization. 50% is based on length of credit. 10% based on new credit or inquiries. And 10% of your score is credit mix. All right. And again, of course, you've been hearing about it, and maybe you haven't been hearing about it. FICO's newest credit score is known as the FICO 9, because right now the FICO 8 has been the one that they've been using, but they're slowly moving into the FICO 9. This new score includes many changes from prior FICO models. And basically, FICO 9, you hear FICO 9, FICO 8, FICO 7. It's just like Windows when they started out with Windows 7, Windows 8, Windows 9, Windows 10. Now they're up to Windows 11. That's all it is, just different models. The same thing, FICO score, FICO 1, 2, all the way up to 9. Sometimes they just make changes like in FICO 9. That one change is that medical collections are no longer scored the same as regular collections that are way much less, right? Which is important. A lot of people got medical bills. FICO anticipates that a consumer with a medium credit score of 711 whose only negative collection issue is medical related will see the score increase by actually 25 points. So other changes, they're going to allow you to be able to use your rent. If you're making your rent payments on time, you can use that to boost your score. Some say your cable bill, some other light bill they'll help you use. So it's a lot of changes coming in with the FICO 9 to help somebody who really doesn't even have credit or trying to build credit. They can now build it through the rent that they make. They pay their cable bill that they pay on time, their light bill, things like that. That's just there. So how do you rate? So the question is, where are you at? Are you below 599? Are you poor at 600 to 649? Are you fair at 650, 699? Good credit at 700, 749? Excellent credit at 750. Where do you rate your score? All right. Go there. So what you can do is, of course, you can contact us. The name of my company is called the Faithful Credit Group, LLC. We definitely consult and help people understand the credit process. And then if you like a free consultation on what we do to help, you give your understanding, build your credit, remove negative items, all that good stuff based on the law, which is the Fair Credit Reporting Act and the Fair Debt Collection Practices Act. Then if you like a free consultation, you can always reach out to us. You're watching this on Facebook, just inbox me, say I would like a free credit consultation. If you're watching this on YouTube, just put in a comment, or you can just email me at creditrepair64@gmail.com. That's creditrepair64@gmail.com, or Angelo McCutcheon1964@gmail.com. Either one of those, you can reach out to me and we'll connect with you and we'll give you a free over the phone consultation. All right, how does that sound? So that concludes our presentation. We just wanted to give you an understanding. You can watch this over and over, but we want to give you an understanding on what understanding the FICO score, which is very important. Understanding the FICO score is very important. Remember, 90% of lenders are using your FICO score. The other 10 may use the Vantage score, which comes from Credit Karma, comes from the credit bureaus themselves. But FICO is the main one you want to look at. You can always go to myfico.com, and they have packages you can sign up for to get all three of your credit scores and your monthly credit report. All right. So with that in mind, I appreciate you guys watching this video. Whether you watched it live or whether you watched it as a replay, type in your comments, hit me up, and let's go. Until then, everybody stay blessed. And what's even more important is that you are a blessing. And with that, have a blessed day.